How does collecting a premium sound, while you pay less for your favorite stock? So, you will be making money while paying less than the current price of the stock you love. Too good to be true? Believe me, it's not. You can achieve this using an options trading strategy called cash secured puts. How does it work? How can you make money with it, and what are all the risks involved? We will discuss all this in today's video. If you like this video and learned something new today, make sure to subscribe to this channel and like this video. With that out of the way, let's jump right into the video. A selling cash-covered put strategy involves dealing an out-of-the-money put option while you set aside the capital required to buy 100 shares of the stock at the option's strike price. The idea with this strategy is to acquire the stock at lower than the current price if the option gets assigned to you. So when and why do you use cash-covered puts? Let me ask you a question. Have you ever entered a limit order to buy a stock below its current trading price, only to find yourself staying around for the price to drop for your order to execute? It would be nice if you could make some money while doing this, right? With selling a cash-covered put, you are able to do that. So if you think one of your favorite stocks is overpriced and you would want to buy it, but at a lower price, the best strategy to do it is with selling cash-secured puts. By opening a cash-covered put, you can collect premium from the option buyer. The buyer pays this money, or otherwise called premium, for the right to sell you shares of stock anytime before expiration at the strike price. If you subtract the premium you will get from the strike price, that will be the exact amount you will be paying for 100 shares if the options get exercised. If you are wondering about the other possibility that you will not get assigned 100 shares, in that case, what happens? You keep the premium and your reserved money is sent back to you. While your intention may have been to enjoy the stock, at least you entered some incitement for staying around for the stock to drop in price. Let's now discuss the steps you need to take in order to invest in your favorite stock the right way. Step 1 is to set away some cash. As you will be selling a cash-secured put option, there's a chance you may be assigned shares if the put buyer exercises the option. When this happens, you will pay the exact amount you selected as the strike price. Setting away the cash for this sale ahead of time allows you to prepare for this option strategy. Remember that one option contract equals 100 shares of the stock. So you'd have to multiply the strike price by 100 in order to come to the total balance you need in your brokerage account before you can write this contract. Step 2 is to collect the premium by selling a cash-covered put. You will collect the premium when you sell a cash-covered put. Once your option contract gets sold, you will see a premium deposited to your brokerage account right away. You can roll that amount to buy some other stock, or just keep it in your brokerage account as balance. Compared to buying a stock outright, in which you'd pay the current price, using a put option allows you to generate some income and potentially enjoy the stock at a lower price. Now let's discuss what are the possibilities of selling cash-secured puts. With cash-covered puts, there are two possibilities. First is that on expiration day the value of the stock is over your strike price and thus no one will sell you their stock at your strike price. So you get to keep the premium and your initial collateral is returned back to you. The second possibility is that the stocks get assigned. So in this case, you buy 100 stocks at the strike price you selected. So you basically are paying for a stock of what you think is the fair value of it, while collecting the premium. The most you can make from the option trade is the premium. But remember, cash-covered puts also have substantial threat because if shares of the underpinning stock fall below the strike price or indeed go all the way down to $0, you'll still be obliged to buy shares at the original strike price. You can see how the threat involved with a cash-covered put differs from using a limit order to buy a stock. And that is why we suggest you all use this options trading strategy for the stocks you think are going to do good in the long term. In any case, I personally buy stocks selling cash-secured puts. This not only allows me to buy stocks at a lower price, but also it reduces my cost basis with the premium I collect. Selling cash-secured puts on weekly basis with only 1% of the profit margin can return you more than 50% return on your initial investment. That's 5 times more than an average market return. Here's a screenshot of me selling a cash-secured put on Robinhood. I will collect $502 on an investment of $37,600 in 1 week. That's a return of almost 1.4% every single week. If the stock price is above $376 on expiration day, I will get my $37,600 back. Otherwise, I will keep $502 anyway and do the same thing again next week. I hope this gives you a good idea of how I sell cash-secured puts as an options trading strategy and how I make money with it. With that said, I wish you all good luck if you try this idea yourself. Thank you for watching.